has time value attached to it. Why is time value attached to the money and how to calculate time value of money? Let's see our topics for the day. Today we'll be covering concepts on time value of money, future value, present value and annuities. Which one would you prefer? 10,000 today or 10,000 after 5 years? Obviously, 10,000 today. You already recognize that there is time value of money. But why you prefer 10,000 today, not tomorrow? Let's see the reasons. Why is time such an important element in your decision? $1 today is more valuable than $1 year hence. Why? Individuals in general prefer current consumption to future consumption. A rational individual doesn't know there is an uncertainty in the future cash flows, so he would prefer current consumption to the future. Capital can be employed to generate positive returns. I can invest in a bank and get money, so I would prefer to have money today. In an inflationary period, a rupee today represents a greater real purchasing power than a rupee hence. A pen today costing $1. Same pen, same model. After 1 year, $1.2. Why? Because of the real purchasing power of money. Product is same, but the money has increased. Suppose you invest $1,000 for 3 years in a bank. That pays 10% interest per year. How much would you get after 3 years? 1,000 is the value today. You add 10% on 1,000, which is 100. That gives you 1,100. On that 1,100 we add 10%, so 1110. We get 1210. On that we add 10%, we get 1331. This 1331 is a future value and 1,000 is a present value. What method of rate of interest did we use? We have two methods of rate of interest. Simple interest, where interest is paid on only the original amount of principal. When interest is paid not only on the principal amount invested but also on the previous interest earned, as we saw in our example, this is called compound interest. Albert Einstein once remarked, "I don't know what 7 wonders of the world are, but I know the 8th one is compound interest." Let's see why so he's called it as a magic of compound. $1,000 is invested at 10% interest rate. At the 30th year, with the $1,000 invested at 10%, you just reap $4,000. But same 10% compound interest, you reap $18,000. And keeping the compound interest lower also, let's say if I go to 7% and having 10% simple interest, still because of compounding effect, even 7% is giving me a higher return. So that's why it's called as a magic of compounding. So let's see how to calculate this. To calculate the future value, we have future value is given by present value 1 plus r raised to t. R is the rate of interest, t is the time. FV is a future and PV is a present value. So now if I tell you that I give you 1,000 a year later, find out the present value today. So I am giving you 1,000 in future and I want you to get the present value. So keeping the same formula here, I just take away, keeping present value there, I take away 1 plus r divided by future value, which gives me the present value formula. Now if I can write present value equals to future value into 1 upon 1 plus r raised to t, yes, it is same, right? I am just multiplying it by 1 upon this. Now this 1 upon 1 plus r raised to t is called as a discounting factor. Now why I use the word discounting? When we were calculating the future value, we were compounding the things. Now when I am finding the present value, I am discounting the things. Discounting is the process of translating a future value or a set of future cash flows into the present value, which is given by df equals to 1 upon 1 plus r raised to t. Let's see, I give you 3 cash flows. Year 1, 1,000. Year 2, 1,200. Year 3, 1,500. Find the present value of future cash flows if the interest rate is 10%. Now, See, I am giving you 3 different cash flows in 3 different periods. In the previous example, I gave you 1000, you invested in the bank, you found the future value as 1331. But now I am giving you 3 different cash flows in future and I want you to find the present value of it. So let's see how we can do it. So we have the cash flows 1000, 1200 and 1500. I have created a discounting factor column where 1 divided by 1 plus 0.10 raised to 10 time. Okay, now how you calculate on a technique on the calculator. Press 1 divided by 1.10 equal to, just keep doing equal to. Okay, you will get these figures. So this is a small technique. You can do 1 divided by 1.10 raised to 2, then 1 divided by 1.10 raised to 3 also. But that was a shortcut which I mentioned you. So you multiply these figures, you get the present value. Now this discounting factor table is also available in the present value tables where you see 10% column year 1, pick up the figure 0.901, 10% for year 2 0.8264. So if we have a look, the total of the cash flows is 3700 but the present value of the future cash flows is 3027. Now this was the cash flows which I gave you uneven cash flows 1000, 1200 and 1500. Now if I tell you 1000 cash flow for 3 years at a constant. So we have a concept called annuity, and annuity is a stream of constant cash flows occurring at regular intervals of time. Okay, let's see how we will calculate this. What is the present value of the constant cash flow? If I say a project would give you 1000 every year for 3 years, rate of interest is 10%. Total value of the of course is 3000. But what is the present value? Go ahead. Now I can calculate this as I showed you for the uneven cash flows where I kept 1000. In the previous example I kept 1200 and 1500. Same way in this example I am keeping it same, multiplying with the discount factor I get the cash flows. But since there is a constant cash flow, I have a formula called annuity factor with which I can directly calculate the present value. So present value is given by future value into the annuity factor. So annuity factor, you can look into the tables available where you go to 10% directly for the 3 years. You see the annuity factor which is given by 2.4864 and you multiply, you get the same value as we did for the uneven cash flows. Or you can go ahead with this formula also calculating the annuity factor. But the point to say is, why are we doing this annuity thing? See, when we have bond valuation coming up and other projects which give us constant cash flow for 15 years. Now, I will not keep on discounting for 15 years, right? If the cash flow is constant, I can directly use the annuity factor. For more details on finance topics, you can contact Palak Rajani at yahoo.com. Thank you.